Welcome to this explainer. Today, we're diving into a really fascinating paradox right at the intersection of high finance, cutting edge tech, and, well, human emotion. We're going to uncover exactly why the financial sector, which is an industry completely obsessed with risk management, is actually struggling to adopt its absolute most powerful risk prediction tools. And as it turns out, human psychology holds the key to fixing this whole adoption crisis. So let's jump right into the central mystery here. Why are the most mathematically accurate AI models basically ignored in banking? Honestly, it sounds totally counterintuitive, right? You'd think risk-averse institutions would absolutely jump at the chance to use the most precise technology out there for predicting loan defaults and credit risk. But when we look at the research, we find they are actively avoiding it. Just take a look at this staggering data point. 6%. Out of hundreds of recent academic studies and model deployments looking at AI and credit risk, probabilistic AI, which is literally the most advanced method we have for mapping true uncertainty, makes up only 6% of the models utilized. That means the vast majority of the industry is just leaving its sharpest weapons sitting on the table. So here's our roadmap for solving this mystery. First, the illusion of safe scorecards. Second, the power of probabilistic AI. Third, the black box anxiety problem. Fourth, bridging the gap with XAI. Fifth, the limits of current XAI. And finally, building XAI as core infrastructure. We're going to use hard banking data and behavioral psychology to really understand this barrier. All right, part one, the illusion of safe scorecards. For decades now, credit risk has relied heavily on these really familiar legacy approaches, mostly the traditional 5C framework. Loan officers do the subjective evaluation based on character, capacity, collateral, capital, and conditions. And look, even as banks upgraded to statistical methods like logistic regression, the output was still just a simple, definitive number, a point estimate. Psychologically, this provides immense cognitive comfort. It feels safe. It's understandable. But the major problem here is that these legacy models just do not have the horsepower to capture the complex, nonlinear relationships hiding inside modern, massive datasets. They're comfortable, sure, but they leave some pretty huge blind spots. Moving on to part two, the power of probabilistic AI. This comparison really highlights the technological leap we're talking about. On the one side, you have your traditional deterministic models giving you that familiar, single-point estimate. But on the flip side, probabilistic AI does something pretty incredible. Instead of just spitting out one best guess, it explicitly encodes uncertainty. It models what we call epistemic uncertainty, meaning the uncertainty inside the model itself because of limited data, and aleatoric uncertainty, which is just the inherent randomness within the data itself. It literally maps out its own confidence. So if a financial shock hits, a probabilistic model can actually adjust its decision thresholds based on predictive variance. It's vastly superior. And yet, like we just saw, it has a measly 6% adoption rate. Which brings us to part three, the black box anxiety problem. To figure out what's going wrong, researchers actually looked at another super high-stakes field, healthcare diagnostics. And it turns out the psychological reactions of doctors using AI perfectly mirror those of credit risk committees. Opaque, black box AI triggers a really complex, multidimensional fear. Users are afraid of automated autonomy, they feel a perceived loss of human control, and they frankly hate the lack of transparency. This isn't just some mild hesitation either. It's a heavily documented psychological construct called AI anxiety. When the tech is opaque, it honestly doesn't matter if you're diagnosing a patient or approving a multi-million-dollar loan. The human brain inherently perceives that lack of explainability as a major threat. Now notice how the Technology Acceptance Model, or TAM-3, maps out the solution for us. If you follow the flow, you see that AI explainability, specifically transparency and accountability, directly impacts two distinct psychological states, cognitive trust and AI anxiety. And the research here reveals something super profound. While explainability definitely increases your logical, cognitive trust, the real pathway to getting people to actually use the tool is through the reduction of AI anxiety. You have to lower that emotional friction first if you want adoption. Okay, part four, bridging the gap with XAI. This crucial point is perfectly captured in this brilliant finding from the healthcare study. Emotional discomfort can override cognitive reassurance. Really let that sink in for a second. You could sit a loan officer down and mathematically prove beyond a shadow of a doubt that a probabilistic AI model is 20% more accurate than their legacy scorecard. They can have total cognitive trust in the math. But if the model remains a black box and they feel emotionally anxious about not understanding how it got to its answer, they simply won't adopt it. Rational trust is totally useless if emotional anxiety is blocking the door. So to fix this, We have to deliberately engineer trust by attacking that anxiety head-on. Explainable AI, or XAI, does this brilliantly in 3 steps. First, transparency. You break open the black box so a human can easily understand the internal decision process. Second, accountability. You allow the bank to trace a specific credit denial all the way back to its exact origin data. And by nailing those 2 requirements, you hit step 3, emotional comfort. You strip away the friction and anxiety that blocks adoption, all while fully preserving the user's sense of control. Part 5. The limits of current XAI. But before we go declaring victory, we really need a reality check here. The current darling tools of the XAI world are SHAP and Lime. They promise to transform these black boxes into perfectly transparent systems. However, recent studies highlight a massive flaw when you apply them to credit risk. SHAP values are not portfolio invariant. What does that mean? It means if you use interventional SHAP versus path-dependent tree SHAP, you can actually end up with materially different explanations for the exact same data. Even worse, the explanations can change depending on the background reference portfolio you're using. Imagine a regulator asking a bank to explain a credit decision, and the bank's XAI tool spits out a totally different explanation just because the overall portfolio composition shifted. I mean, that is a massive compliance disaster waiting to happen. And finally, Part 6, building XAI as core infrastructure. The main takeaway from those limitations with SHAP and Lime is crystal clear. Explainability cannot just be a post hoc patch that you slap onto the end of a black box model. It has to be built in as foundational, ground-up infrastructure. To survive regulatory scrutiny and overcome human anxiety, banks really need to integrate prior knowledge, things like macroeconomic relationships or historical default rates, directly into the probabilistic frameworks right from day one. By embedding domain expertise as priors in a Bayesian model, the outputs actually stay economically meaningful and, most importantly, deeply understandable to the humans using them. So, we've seen today that the math alone just isn't enough. Traditional scorecards are cozy and comfortable, but they're way less accurate. Probabilistic AI is incredibly powerful, but it completely fails adoption when we ignore the human element and trigger AI anxiety with opacity. By using models designed with core infrastructural explainability to reduce that emotional friction, financial institutions can finally unlock the predictive power they've been leaving on the table. So I'm going to leave you with a provocative thought to consider for your own organization. Will your next credit model just predict risk, or will it explain it? Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.